Life as You Own It with Mark McDougall and Craig Miller.
Remember, you got questions, we've got answers. You may not take the time to educate yourself about the single largest investment and opportunity you have, that investment in the roof over your head in real estate.
We talk about your home, financing, making investments in real estate. We give you the facts, folks.
You know, it's just good old-fashioned horse sense that we like to talk about. And we also throw in some other horse stuff, too, just for fun.
Alrighty, Life as You Own It. I'm Mark McDougall. He is. Who are you? Who's
Craig.
that? Who is
Craig.
that masked man? All right, we're coming at you. Hope you're having a wonderful weekend from our intergalactic headquarters in the heart of the Midwest, Kansas City. So,
In the
those of
intergalactic
you,
heart of the universe.
It is the intergalactic heart of the universe.
That's right.
And we hope that you are enjoying some pleasant weather wherever you are, and we want to welcome a brand new affiliate in the Pacific Northwest. We are excited to have representing the South Sound in Washington, the South Sound region, KMAS, the most recent family member to the
KMAS.
Life as You Own It network. You got any
KMAS.
friends? You got any friends in
I
that
do.
area, Craig?
I'll
You do
give
now.
a shout out to Josh Harvard out there. He's up in Seattle just taking care of some business.
All right.
I'll have to reach out to him, tell him to tune in if he hasn't already been tuning.
So if you're checking us out for the first time, we are your one-stop shop for everything under the roof over your head, whether you're a renter or an aspiring home buyer or a real estate magnate like Craig. And I say that because you own real estate and you have a magnetic personality, so that makes you a real estate magnet. Not to be confused with a real estate magnate.
That's
I don't
right.
know, is it?
I'm neither.
But you are magnificent. So regardless of your situation, we're going to help you get the latest tips on how to better take care of that investment, how to prepare for your financial future by, getting a financial plan, how to get your best deal on insurance, how to get the next job, how to dress better, and how to just be smarter. That's what we cover in a typical installment of Life as You Own It. Hey, Craig, you paying attention to me?
I am, but I'm also sending Josh Harbert a message right now to tell him to turn on the radio.
Oh my gosh. We might also sometimes discuss ADD or ADHD because there might be at least one of us in this room. At least 50% of the people doing the show today might be afflicted with AD or ADHD or one of those double Ds. ADD,
I don't know, I forgot
ADHD.
what I was talking about.
You got an A, exactly. So, folks, we got a great show for you today, and we are pleased that you are joining us. Remember, you can check us out on a growing list of stations, and if you're not hearing us on the airwaves and you're just catching us on a podcast, or maybe someone sent you a link to the show, iTunes, YouTube, that you can go to Tuned In Radio and iHeartRadio, all those places you can get us. But we also want to come at you in your local market on the radio. So if you want to catch us on the radio, call your local station. Tell them we want Life as You Own It. Those guys are just funny and full of information. So we want to hear from you. 800-270-6425 is the number. Shoot us your questions. Questions at lifeasyouownit.com. You got a question, we've got an answer, or at least we will make one up. That's what we're committed to. So today, attention home buying procrastinators. This is your last call. It's time to get off the fence. We'll tell you why you need to buy a house. When, Craig? When should they buy a house?
Now.
Also, so you're ready to buy, and you're fully off the fence. Not one leg on, 1 foot on. We got the visuals. Do you know how much money you will really need to buy that new house? It's not just the down payment. There's a little more involved. And when can too much optimism be dangerous? Craig, when can too much optimism be dangerous?
Always.
It happens to the best of us overly positive types, but when it comes to financial optimism, I think we'll agree too much of it is not necessarily a good thing. And what's that smell? What's that smell, Craig? Craig!
That's my new cologne.
Did you have Thai food for lunch again?
C28.
C28. Is it your house? If you're trying to sell
my tailpipe in the car at a gas station.
If you're trying to sell it, we'll tell you what buyers might appreciate and what they won't tolerate in a smell. There's some things they may not tolerate if they were in this studio.
Little teaser hint.
Brute, you know what?
Brute
33 by Fabergé. That's what I wear because I'm retro. I'm
Remember
old
when
school.
you used to wear high karate?
I loved it when he wore high karate.
Was that HI karate or
high
HIGH?
karate, and he wore Stetson and some of the other ones. Like
yeah.
gray flannel.
Gray flannels. Yeah, classic. Old Spice.
All that good stuff.
Smell like my grandpa. Okay, so...
that was an improvement over what you smell like now. That
That's
I
right.
Go back to those days.
So, folks, a typical show has Craig and I enjoying ourselves for an hour
Talking
and
some
hopefully
smack.
sharing some information that you will find valuable in your daily life. And remember, our Should You Stay or Should You Go segment. Later in the hour, you're going to hear some music playing, and ironically enough, the music is Should You Stay or Should You Go?
Hey, that's
and we
interesting
will give a real listener scenario where Craig, sometimes I, will tell you if you should stay in that loan, stay in that relationship, stay in that home, and it will be quick and concise if I give the answer. Or it'll be a lengthy diatribe if Craig does. But that's what you should expect each and every show. So next up is Craig kind of kicking off the show. Maybe we'll mix it up next time because I bet you we got a lot of mortgage companies out there listening go, what are the rates for this week?
Because they don't know. 'Cause they just don't
And
know.
our listeners, but we at the beginning of the show, we give you a national average for interest rates so you kind of know where you are in the deal you're considering or in the deal you're already in. And without further ado, Craig, let's jump on those rates. Unless there's anything else you want to discuss.
When are the folks in Seattle going to be able to tune into the show?
They're in this weekend.
What time?
Tomorrow. I mean, tomorrow, this all weekend. I believe it's actually Saturday at 7 a.m.
7
I think
a.m.
KMS, all three affiliates there. KMAS, 7 a.m. So rise and shine. We hope you're up. We hope you're enjoying the show. And again, we appreciate you listening and giving us a shot. And we encourage you, call the station manager. Call the station and say, I like these guys. Play them 5 hours a day. All right.
There you go. Okay, now Josh.
Do it, Craig. Focus, Sensei.
Yes. Alrighty then. Rates, folks. We're going to bring you these national averages, as Mark said, every week. We're usually going to do it at the beginning of the show, but I think Mark wants to start mixing that up. We'll see what happens
I might.
next week. Tune in
Keep
next
you on
week
your
to
toes.
find out what happens with interest rates. We don't care whether they go up or down. We just want to know when you're going to talk about them. All right. So last week, I'm going to share with you what we do every week. We give you the previous week, then the week that just passed by us, and then where we think rates are headed. Typically, we'll try to opine, but we don't always know. We never know, actually. What am I talking about? There's no crystal ball. These are the averages that are based upon nationwide stats. Doesn't mean this is exactly the quote you'll get. As always, there's a parameter to come up with an average. So what's used is a $200,000 loan amount with 20% or more equity and someone with excellent credit. Obviously, variations thereof could affect what type of rate quote you get and the type of loan program you may qualify for. So looking at 30-year fixed, previous week, we were at 4.20. This past week that just went by, 4.24, so rates went up just a little bit. 3.20 this past week on 15-year fixed, but the week before, 3.27, so improved there slightly. What we're seeing here is 15-year or short-term mortgage rates have been improving slightly, and adjustable rate mortgages sometimes improving slightly, while the longer-term 30-year fixed-rate mortgages have actually gone the other direction. It's an interesting situation when normally they all move together. 5-year ARM, where your rate would be fixed for 5 years and then go into the adjustment period, 3.32 versus 3.36 the prior week. And 3.72 versus 3.84 on FHA 30-year fixed. So FHAs did improve slightly. The only thing that did not is a 30-year fixed standard conventional loan. So where do we think rates are headed? I'll tell you where I think they're headed. I think they're going to remain either flat or I think they're going to get slightly worse. I think you should take advantage of what's in front of you right now. And the reason why is this. We have butted up against resistance in the mortgage-backed security bond trading, which, by the way, folks, is how rates are determined. That trading that happens day by day as the market is open, it dictates what interest rates are. And what we found is that there's a resistance level that we've banged off of multiple times in the past several weeks, if not months, and it's just not been able to break through. We just don't see rates getting any better with the Fed stepping out of buying treasuries and mortgage-backed securities. They're trickling down on that, combined with just the pressure on the market as a whole. So what we would suggest you do is if something's in front of you right now, a refinance opportunity, a purchase opportunity, get locked in, take advantage of the rates that are there. Don't expect to hold on and save a bunch of money. If rates improve, maybe they will. They might improve by an eighth of a percent, maybe even a quarter, but they've got a lot more opportunity to get a whole lot worse than get a lot better. So I say jump on it. That's your rates for the week. What's coming up, Mark?
All right, so home buying procrastinators, this is your last call, I think, because if you're going to buy a house, we think now is the time if you've been sitting on the fence. So you ready, Craig? Ready to do this?
I'm ready.
I've got 3 reasons you need to buy a house now. Don't wait another moment. And I'm going to give you those reasons. We come
That's
back
right.
from
I was
the
gonna
break,
say,
folks.
let's hear it go.
It's the way good
auctioneer.
radio works, and sometimes ours works that way also. Life as you own it. Stay tuned.
All right, friends, we are back. Life as you own it. Mark was just getting us all lathered up there for this.
I was.
Three
Was
things that
indeed.
you
And I want
did
to
too.
give a, you know what, I appreciate that, Darren. I know why you're playing that music. I know why. You know, I thought of it before the show as a nod to our new listening audience in the Pacific Northwest. You know, we're gonna play a little bit of music that we know is familiar to them. Since what was the movie? What was the movie? Oh, come on.
Singles.
We're gonna have to-
Singles.
Singles. There we go.
I don't know the movie.
That's before your time, Craig. This was
Mhm.
back in the.
Being that I'm
This
32.
was back in the late 90s. Okay, probably the early 90s. That's right. I was a little farther in the Northwest. I was
Was
in
in elementary
Alaska
school.
when that movie came out. Yeah, Alaska. Cleaning fish. Okay, so 3 reasons to buy a house now, Craig. I've got 3.
Let's
You
hear
got 3. Give me your 3, and we'll see. We'll compare our 3 reasons.
Because you want to.
That's right. That's right.
It's a darn good deal.
So number 1, Craig. What do you think a good reason would be?
Home prices
Quick.
are still off of their highs.
Yeah, folks.
There's still good markets out there.
2006. Everyone knows we peaked, and we saw significant rundown in home values. Everyone that's listening to the show knows that story all too well, and we've seen some nice movement back, some steady appreciation as we've seen a healthy-ish economy, lower unemployment, and it's done exactly what we would have hoped. We just would have hoped it would have come sooner. So we've seen it. We've seen home values starting to go up with a little more velocity. But right now, it's still a fantastic time to get a great deal on a home. The issue we're hearing more of is a little less inventory. But don't sit on the sideline too long, because we do not see home values trending back the other direction anytime soon. I'm predicting continued momentum with modest appreciation in the foreseeable future, into the foreseeable future. What do you think about that, Craig?
You know, I'm going to have to say that I don't know what's going to happen next year. I have a strong suspicion that we're going to see a little bit of a stalling period in the late part of 2015. So, depending on how severe that is, we'll see. But I'm putting this little prediction out there for our listeners.
What's that?
Next fall, next late summer, early fall, we're going to see a major correction in the market in general. I think that'll slow down house buying. I think it'll affect house prices. We'll leave that on the table.
You think they'll go back a little bit?
I do.
What's your year-over-year appreciation prognostication for now to next fall?
Oh, 2 to 4%. I don't think it'll do a whole lot more than that.
I think
Something like
that's a conservative number. That if at 4% it outpaces inflation, and that's above where it's historically trended. So I think it's a good. I'll agree that I think probably between 4 and 8% over the next 12 months is the aggregate appreciation nationally that we'll see, and I think that's a pretty conservative number. But that means that that $200,000 house is going to cost you, if it's 8%, it's going to cost you $16,000 more this time next year on the high end. If Craig's right, it's going to cost you $122,000 less. Because we're just good with math. Just kidding!
That'd be close.
It's going to cost you the same, and you think it's going to stall next year. 4% there. So that's one reason. Save yourself up to $16,000, $20,000, $25,000, $30,000 by purchasing now instead of waiting till next year, and you've got that appreciation. What else, Craig? There's another thing that,
We do see interest rates continuing to rise. We expect them to continue to slightly go up. I don't think they're going to skyrocket, folks, but I do believe rates could potentially hit 5% before spring of next year. I don't know that it'll happen by the end of this year, but it very well could. It just depends on what happens with the Fed action. As they pull out, the reaction in the market's going to dictate a lot of that. But if rates hit 5% or greater this winter, or early spring next year, that's going to affect.
And it affects, talk to our listeners real quickly about the real cost of, say, a percent move in interest rate to their buying power.
Sure. Well, if you've got an interest rate, let's just say right now you can take a rate of 4.25. We're going to use that, and then rates are at 5.25. That 1% increase on a typical average loan amount nationwide is over $100 a month. It's $100 to $120 a month. So and if you figure about $5 or so per thousand that you borrow, you're looking at $20,000 swing or more, $20,000 to $25,000 swing in price to get to that same payment. So in other words, if rates go up 5 to 5.25 from 4.25, you'd have to be able to buy that home for $20,000 to $25,000 less to keep your payment the same.
So understand, folks.
Significant amount of money when you think about what 1 point does.
You double that up with the increase in the likely increase in home value this time next year or next year, and it starts to become a sizable amount of money that by sitting on the sidelines you may be having to invest in that same house. Also, another key piece we've seen over the last 3 years, our rental rates continue to rise, folks, and they continue to outpace significantly. They continue to outpace inflation. So your cost of living and renting continues to go up, and so it's something that you can keep paying the man, keep paying rent, and watch your investment not increase because you don't own it, or you can consider getting off the fence and buying. And this music, this beautiful music, means it's time for Should You Stay or Should You Go? You ready?
I'm ready.
You sure? All right. Brett in Tulsa, Oklahoma writes, I have a $123,000 balance with a value of $200,000 or so. I need $5,000 for an emergency, and unfortunately, I don't have an emergency fund. I have a rate of 5%, so I know I can get lower, but I don't want to pay a bunch of fees just to get my hands on $5,000. How do I do a zero-cost loan like you guys talk about on the radio show? Good question.
Brett, can't give you a stay or go on that. I'm going to tell you to go. I'm going to tell you to go refinance. I'm going to tell you how to do it. I'm going to tell you how to do it at no cost. Here it is, buddy. First of all, you don't need to do a cash-out refinance most likely to get your hands on the $5,000. I do believe you should take advantage of refinancing in today's market. You've got a lot of equity there. I'm assuming you have good credit. You have a rate of 5%. You should be able to lower your interest rate to the low to mid-4s with no closing costs of any kind. Someone should be able to provide you that type of a deal. So it's going to shave money off the rate, and you're going to do it without any fees, so it's a no-brainer for you. How do you get your hands on the $5,000 though? Well, good news. You can get 2% or $2,000, whichever is less, at closing, or I'm sorry, whichever is greater,
Right.
At closing without it being considered a cash-out transaction. You can also skip a mortgage payment, and if you set it up right and ask your mortgage planner that you're working with, hopefully you're working with a certified mortgage planner, how to set up where you'll skip potentially 2 payments. There's going to be some additional money for you. I'm assuming you've got at least about a $1,000 mortgage payment, and then you're going to get a refund on your current escrow account. You can finance in the new balance of the required escrows into the new loan, so that money will be refunded to you that's currently sitting in the current loan's escrow account. By the time you factor in the $2,000, skip a payment or two, and your escrow refund money, you'll have your $5,000. You don't have to treat it as a cash-out loan, which would probably have a higher interest rate. And you can,
I do have a question on it,
yes, sir.
and real quickly, on the higher interest rate, you being the guy that does this every day, is there with a 123 to 125 loan amount on 200 value, is it going to have
on a 30-year
much,
it would.
much of an impact?
It would be an eighth of a point probably
yeah,
on the rate.
Got it.
So the regardless though, there's really no reason to do it with a cash out loan to get your hands on that money because it's just an easier
Might be
rate
that's
terms,
probably
easier
the most
transaction.
efficient way, as Craig said, to do it. So. Good stuff, Mr. Mellon.
Yeah, so there's your answer, Brett.
Hey,
Get
and
it
I
done,
want
buddy.
to, you know
Save
what?
some
And
money.
I will give it. I'll make sure everyone knows that this advice is available to you 24 hours a day, 7 days a week. Let me give you Craig's cell number right now.
Call it.
It
You can
is
text me all through the night.
555. No,
Yeah. There it is.
No, but seriously, if you've got a question, you've got a scenario, Craig can give advice in all 50 states and Guam.
That's right.
Well, I don't know. He went for a
Puerto
special
Rico as well, and
certification.
I'm not joking
No,
about
no,
that.
no. You were outlawed in
Puerto
Puerto
Rico.
Rico. Yeah.
Oh,
they-
the Speedo thing. We don't
Yeah,
want to talk
yeah,
about
that's
that today.
another story.
The
But
whole Speedo
no,
incident.
seriously, folks, you have a question. Craig, not only can he give you advice in all 50 states and beyond, he can also, believe it or not, facilitate a potential mortgage transaction. One thing he's not going to do, he's not going to facilitate a mortgage transaction for you if it doesn't make sense for you financially. That's one thing he won't do. That's his
Won't
commitment.
do that.
All right.
I'll tell you that.
Okay, Craig, so moving on down the road. We told our listeners 3 reasons they need to buy a house now. Don't wait. Home values are going up, rates are going up. All those things are going to make it more expensive. Also, how much money do you actually need to buy a house? Rosa, do you know? That's
A
our
lot.
friend
How much
Rosa.
money do you need?
A
Rosa?
lot.
You need money, right?
Not to be confused with a great deal.
Right.
Yeah. As you probably can acknowledge, a down payment is just one piece of the puzzle, but it's usually the biggest piece.
Right.
So number one, you got to have a down payment. Just how much of a down payment you ask? Well, it depends. There are some programs that allow for no down payment, VA, RD, and some other maybe local municipality programs, or you can go FHA, or you can go all the way to 20% down and no MI loan. We'll talk a little bit more about those when we come back
Tell
from
them
the
how to
break.
put less down and no, am I still yet?
Life as you want it. All righty, we're back. So I've noticed that whenever we're podcasting the show, video podcasting it, it's a new, we're really high tech here. Rosa here is running the camera, which is an iPad Mini, and we're working on making eye contact with you, the listeners that are watching and listening on the video podcast. But I've noticed Craig is a little bit closer to the camera than I, so it makes his arms look bigger than mine.
That's what it is.
I want to make sure everyone knows that
Let's
it's
put him up there.
completely an optical illusion. It's because he's much closer to the camera than I am. I'm farther back.
Yeah,
It's also,
that's
he
what
press.
it
You
is.
do the trick. You press your hand up behind your bicep. He's constantly
Just
doing
roll your
that.
sleeves up there, Mark.
That's right. Okay,
See what
folks. So we'd
happens.
encourage you check out the podcast, the video podcast. There's some. We don't edit everything like we do on radio, so
No, we don't.
you will see a little bit of what goes on, and you will notice that Craig is constantly afraid of making eye contact with me. I think he's keeping
Last
something
time I
from me.
made direct eye contact with you for more than half a second. You kissed me
You
on
melted.
on the
You
lips.
melt, folks. So we encourage you. As you can tell, we like to have some fun. We'd recommend that you podcast the show. You follow us on YouTube because we will do bonus clips to the show. We take some of our pieces. We'll add some advice. We may do a should you stay or should you go scenario. We send it out. You can get it on the. You can get it if you follow us on YouTube. YouTube. You
Go
can
to
also
YouTube, actually. It's a good site.
you can also go to the website liveasyouownit.com, and we've got all the archived shows, all the information that you would need. All right, Craig. So we're talking about down payment options. We're fans of putting 20% down. It's a very efficient way. You get your best rate. You have no mortgage insurance. But moving up from there, you can go options that would be less down payment. Might be 15% down and doing a HELOC for the 5% difference, or lender paid MI. You want to talk a little bit about those and then move on up to the 100% programs.
Yeah, and a slight correction there. I mean, you won't always get your best interest rate with 20% down. Believe it or not, on certain loan programs, if you put 10% down and you have mortgage insurance, sometimes the rate is slightly better because it's an insured loan. Sometimes you can pick up an 8% and get a slightly lower rate. But I will say this, paying monthly mortgage insurance is nobody's favorite thing to do, and almost everyone has some type of aversion to that, regardless of potential current and future tax deductibility of the mortgage insurance. So what we always suggest you do is take advantage of lender-paid mortgage insurance. That's where the lender purchases a flat fee, one-time paid contract to insure that mortgage to meet the government requirements, but it's paid for by the lender out of their own profit margin or out of their margin they have on the interest rate, so that you do not have to pay that monthly mortgage insurance. If you're someone who's very savvy with your money and you have a strategic plan, putting down 5% or 10% and then taking advantage of lender-paid mortgage insurance would potentially be a better strategy than going ahead and putting the whole 20% down. It all depends on what kind of rate of return you expect to get on that money, but we believe in having a balanced portfolio, a well diversified portfolio of your investments. And when you invest in real estate by putting money down, that's what you're doing. You don't want to overshoot it. So make sure it's balanced, make sure it makes sense. Look at your overall financial picture before you decide exactly what's right for you as far as down payment, and speak with a certified mortgage planner that can look at your assets and look at your situation and help you decide what's going to make the most sense.
All right. So as we mentioned, there are numerous programs to include RD, rural development, which is 100%, VA if you're a veteran. There are also states and municipalities that have special programs that may give bonds, may give silent seconds, etc., that'll get you a low down payment home loan. All right, that music means it's time for another Should You Stay or Should You Go scenario. And Craig, are you ready? Are you ready?
I'm ready, Mark.
All right. Rita in San Jose, California emailed, great show, guys. We need you on our local talk station. Yes, you do, Rita. Thank you. I currently podcast as my sister is in KC, and she told me about your show when I was buying my first house. I now have owned my home for 6 months, and I think it's worth $450,000 or more. I only paid $375 because it needed work, and I've fixed everything now. I put 10% down, and I have PMI. Can I refi and use the value to remove the PMI? Thank you for the help. Thank you, Rita, for emailing us, and thank you for listening to the show.
All right, Rita, so go. You didn't mention what interest rate you have, but I would suggest you go either to the lender you worked with previously, if you have a good relationship with them and they did an excellent job. If you weren't completely impressed by the work they did, then I would suggest shopping around, talk to a few different people. But yes, you can refinance and you can use the value after 6 months. You've done some home improvement. You have continuity of title requirements. So 6 months and beyond, you can take another look at that appraised value depending on the type of improvements you've done, and of course making sure that you've been entitled long enough. So it's worth a shot to go back and take a look and see if you can use that equity that you have now to eliminate the mortgage insurance.
Good stuff, Craig. And you forgot to throw in there, they could actually also reach out to you, as I mentioned.
You should just call me, Rita, now that I think about it.
You could.
Sorry about that.
800-270-6425. Speak to the legend himself. Okay, so how much money? So we talked about down payment, how much you need, okay? Also, you have closing costs. Craig, what's a range for closing costs on a purchase transaction?
Well, this can vary widely depending on what part of the country you're in, because some states have certain taxes and fees and transfer fees and so on, but title fees vary as well, depending on whether you're in a state that requires certain attorneys involved, whether it's a state where you pay all the title fees or the seller pays all the title fees. There's a lot of variations, but I'm going to give you a big range. As far as dollars-wise, you're going to look at anywhere from $1,500 to maybe $5,000 or more. What you can do is, use a percentage of as a general estimate, the percentage of purchase price. You're going to want to figure between 2 and 5% for your expense for closing costs. So that can add up quickly. You got to plan for that, prepare for that, or you can also negotiate for the seller to pay those things on your behalf. In most cases, that's allowed in most states.
Or another mortgage planning concept would be take a slightly higher interest rate and do a no-cost purchase transaction.
Exactly. We do a lot of that.
Yeah, it's just strategic thinking. And remember, if you do Craig's break-even formula, you may find you come out ahead. In fact, I'm certain you will come out ahead by doing the math. You'll come out ahead by staying tuned also. So we'll be back in just a few minutes. We're going to share some more costs of buying that home and so much more. Life as you want it. Stay tuned. All right, Craig, so the cost of buying that home, okay, you've got your down payment, you've got your closing costs, and now you've got home insurance. Not just home insurance, you also might have a homeowners association dues. And those can range anywhere from maybe $30 to $50 a year on the low end, up to thousands of dollars. It depends on what your home's association offers in the form of amenities. Also, if you're in a condo or a townhome, condos, those are going to be higher. They can be, sometimes they're 75 cents a square foot. That can be kind of pricey. Sometimes in some markets they may be even more. So remember, factor that in. It's a pretty big cost associated with your home ownership. Now, as we will, in the next one we're going to get to on if you're in a condo, you pay those, but that does offset a lot of this, a good chunk of the standard maintenance that you would do, the exterior maintenance, the ongoing, landscaping, all those kind of things that you would normally be paying for. That's what those condo dues are for. So make sure you know those costs. Anything you want to add on there, Craig?
No, that's covered.
I will say, shop around. You can't shop around for your HOA dues or your condo dues, but shop around for the insurance. Make sure you've got not just the right coverage, but it's at the right price. You'd be amazed at how many people sometimes think they're saving a few bucks, but they don't have adequate coverage, and vice versa. Sometimes they think they got a great deal, but they haven't shopped around with an independent agent, and they are potentially paying more than they should by hundreds, if not thousands of dollars. All right, so Craig, we talked about you've got now the lender's fees, which we kind of lump into the closing costs, but in some markets, believe it or not, those are handled like they're mutually exclusive events. We consider closing costs really everything it takes to close the loan from a lender fee standpoint, plus we kind of threw in those escrows and prepaids. We've covered those. But in many markets, lender's fees can be anywhere from it might be an origination point, might be a half of an origination point, might be 1.5 points. So it can be several $1,000s. When you're speaking to your mortgage bank, make sure you understand, what am I paying for? What am I getting? And as we discussed previously, what are my options to have a lower lender fee? Does that make more sense for me?
That's right. And there's going to be other fees that a lot of people don't pay attention to when they first get started, and they start adding up, and then I see people step back, especially those putting a lower down payment down who are kind of stretching a little bit to get that home bought. They'll say, well, I do need to get a home inspection, don't I? I need to get a termite inspection or a pest inspection or radon or whatever else. So depending on the type of inspections you choose to get, which, by the way, I just spoke to a gentleman a few days ago who chose to buy a home without any inspection process whatsoever. He felt like, it's a foreclosure, I'm getting a good deal. He is hurting bad, costing him multiple tens of thousands of dollars to fix a bad foundation that he should have known about, that any inspector would have found, and he would have never bought this. Unless
you are very financially well established and are very savvy as it relates to the ability to remodel, etc. If you're not getting a 50% or more discount on a home, then get a home inspection.
Absolutely.
Please. Oh, love that music. All right, Craig, should you stay or should you go? You know, there's a funny thing that I do every segment. You'll see me if you watch the podcast. It's like I put the sheet that has them on there. I'm always looking
Can't
for
find it.
It's a little game I like to play with myself called hide and seek. Teresa in Roland Park, Kansas called to ask, what would you guys advise me to do based on my scenario? I owe $176,000 and my realtor said my house is worth about $170,000 tops. I bought the home for $195,000 in 2007. My interest rate is 5 7/8 and I have 23 years left. I'd love to refinance to a 15-year loan to build more equity. Please help. Help Teresa.
Teresa,
Craig, help her.
You know what? I'm going to help you. You need to go. You need to go refinance. I don't know what your credit situation is. I'm going to assume it's adequate in order to refinance. You can definitely lower your rate and save money. How, pray tell? After all, you did tell us that you owe more on your house than it's worth. You should be able to take advantage of a HARP refinance based upon what you're saying here. Now, I don't know if you've refinanced or not. You don't give us all the details, but so I'm going to make my assumptions.
If she's got 23 years left and she did a 30-year,
and you did 7
she
years,
wouldn't have.
We're deducing that you never refinanced this thing.
We're deducers.
We've deduced and deducted.
We'll seduce you with our deduction.
That you
with
are
our
going to be
deducing.
able to do a HARP loan. You should be able to qualify for a loan that gives you the relief to take advantage of refinancing, even though you may owe more on your home than it's worth. So get with a reputable lender. You can also call me. We'll discuss it. 800-270-6425. We'll look at everything to make sure it's right. But make sure the person that you do work with is familiar with the programs and also is not going to, you get excited. Wow, I get to save all this money now. I'm so pumped. And gouge you with a bunch of extra fees. Watch those fees.
All right. Also, this is a big one, folks, is what's the cost of the maintenance that you're going to need to do up front, and what's going to be the ongoing maintenance you'll need to do? That's the cost of buying that home, renovations and repairs. You got anything you're going to have to do right when you move in. Consider if it's got to be done to bring it up to snuff for you to live in, then it's a cost of purchasing that home. Is it going to be $1,000, $3,000, $5,000, $10,000? You're going to have to put electrical in for the washer and dryer. What are you going to have to do? Is it going to be landscaping? Those things. What are you going to have to do to make this home a home? Not just safe and clean and all those things, but to meet the needs that are an investment you're going to have to make. And then anything you want to add on there, Craig? Then the last one. What's the last one, Craig?
All the little stuff that you don't think about until you step inside the house and go, wait a minute, we got to mow this grass, or we should probably get a chair or a couch for that room over there, or whatever, washer,
or
dryer.
a patio set.
Outdoor furniture. Another big one? Fence. If you have pets and a dog and you haven't thought about how much it's going to
Or
cost
you
to
live
build
next
a
to
fence.
Craig.
Or an underground, those little underground fences, a little electrical fence so you can shock your dog to death every time it tries to get out of your yard. Those things. Fixing up the landscape,
Or your
picking
spouse.
weeds, mulch, doing whatever. I mean, all this little stuff. You're going to take pride in your new home, and all of a sudden you're going to want to do all these little things.
You're
to make
buying a
the
rake.
home the
You're
home.
buying a...
You got to pay attention to this stuff, folks. You got to pay attention to this stuff.
All right, folks, we're going to take a quick break here. When we come back, we're going to talk a little bit more about the excessive optimism that I think some of us have subjected ourselves to. Craig, shame on you for being excessively optimistic.
I'm not going to lie about it. I have absolutely learned my lesson about this, but I've been many times in my life excessively optimistic, and I'm not doing that anymore.
And so
I'm not going to be pessimistic.
the
but
big
I'm not gonna be
question
so
we want
optimistic.
you to contemplate while we're taking the break is, what's in your budget? Life is your own it.
I got to be honest, Mark. To let
Please
you know.
do. Let me know.
Let you know. Let you know about consumers with excessive optimism. What's
Shame
that all about?
on you, and I think we'll agree. If you've got excessive optimism in your financial affairs, it will possibly lead to. We'd rather you be a little bit pessimistic about that's going to force you to do the planning that we believe is essential to get ahead. So our friends at the National Foundation for Credit Counseling, we've got some material for them we want to share with you, and we're asking the question: what's in your budget? These are the things that should be. If you're planning for the unexpected, we recommend that you've got 6 to 12 months minimum in what we say reserves. It's usually not the daily routine expenses that wreck people's budgets. It's the emergencies. Prepare for these by socking away 10% of each paycheck into a rainy day fund. Minimum is a year. Minimum a year is our safe. But you got to start somewhere. Tackle the 6 months. High five your partner or high five yourself, and then get it towards that 1 year. All right?
Absolutely.
Next, Craig.
So you've got your periodic expenses, your
Right.
known periodic expenses.
Know
So
what? That's a part of your budget for these things.
birthdays and anniversaries and holidays and things like that most people think, okay, I know what my gas bill is, my house payment, my car payments, and da-da-da. Think about the months of the year that you have people who you always celebrate by buying them a gift or having a holiday dinner at your home, or any of those things that you spend extra money on. Those are the months that sneak up on people. Your expenses spike up, boom, more money than you were planning on spending.
You got too much month at the end of your money. Next is obviously long-term savings. We talk about it a lot. That's a part of your budget. That's something you've got to be doing. Put aside that money for retirement, etc. Household and vehicle maintenance. Is that in your budget? Are you accounting for the $200, the $300, the $600, the $1,000 a month it's going to cost, not just for your car, but also for your home maintenance? What else, Craig?
You've got travel. What about travel? Have you budgeted for that?
Family vacation.
Family vacation. You got to have that as part of your normal budget, or don't take the trip. Don't decide on a whim. Oh, great, we can save some money by getting the special on these plane tickets, and then we'll just stay at a budget place and blah, blah, blah. I hear people say all the time they decided at the last minute to take a vacation, get away, the family needed it, and they spend about 3 times more money than they were planning. So, you got a budget for
They didn't plan for it, right. Major purchases, buying a home, buying a vehicle, remodeling your house. Are you planning for that, or are you charging on a credit card because you didn't plan? What else?
Charitable giving. Do you like to give to charity? Are you going to support a number of charities that you've supported in the past annually? Make sure it's part of your budget. And always set aside something to help. If you've got a little bit of excess, give back, folks. Just give back.
The first thing we remind you, though, is you got to give to yourself. If you don't, it's great to be charitable, but if you don't have enough money in reserves and you haven't buttoned down the other expenses that you have, don't throw that extra money in the collection basket necessarily if it's going to cause you to now run up a credit card to pay for your expenses for your groceries. Next is health insurance choices. Are you going through making sure you're taking advantage of what your employer offers you? Are you looking at your personal plan if you're self-insuring or paying for your insurance outside of work and making sure it's covering you appropriately but most cost-effective? Through your employer, there are a lot of options that I guarantee can save you money or leaving money on the table. What else, Craig?
Your actual investments. You've got a budget to invest money, not just your long-term savings, but your actual investments themselves. IRAs, contributing to your 401k. Any other type of investment, stocks, bonds, mutual funds, those things. So make sure you put that in the budget as well.
All right, folks, all of that should be in your budget, and if you want to check it out in more detail, you can get to the website, lifeisyouownit.com. We will share this, won't we, Rosa? Thank you so much for all that you do, Rosa. You're a sweetheart. Okay, so the last thing is your house. Is it melodious?
No, that's music, Mark.
Melodious.
Is it odiferous? Is
Odiferous?
The word you're looking
Yeah. Malodorous?
Melodious, it can be if you have a little bit of background music playing when they go
So,
through.
folks, one of the things, someone comes in to buy your house, if it smells like these two things are the most common, pets and cigarette smoke. Those are, we hope it's not BO, it could be, but those are the top two are pets and cigarette smoke. I'm telling you, scrub the house, get the pets out, get the cigarette smokers out. If you're trying to sell your house, nothing will turn off a prospective home buyer. Even if they're a smoker, you'd be amazed. They're going, I don't want to live in this house that smells like
Where you
smoke.
store your dirty laundry. If you got a hamper in your closet, you can get that kind of dirty laundry smell in your closet. Don't do that. Find a way to freshen that room up as well.
Like they say, Craig, get out of the closet. All right,
Yeah.
folks, this has
They
been
always
another
say to you.
installment of Life as You Own It. We appreciate you hanging out with us all weekend. Have a great work week.
Stay classy.
Stop waving your finger at me.
Just trying to keep
Stop
you.
it.
You want to redo it?
No.
Do we need to?
No, it was
I think
pretty-
you need
it sounds normal.
Nope.
It sounds like people.
Says you need to.
Okay,
let's-
whatever.
We'll do it if it,
We're not
and I'll go back and
professionals.
edit it if it doesn't
Oh,
sound
yes,
good.
you are.
Stand by.
You are professionals.
I gotta check something real quick.
Speaking of freshen up, tune in next week for a fresh episode of Life as You Own It. And remember
oh,
to...
wait. Sorry.
Oh my gosh!
That was
perfect!
good. That was good. It's going to be hard to recreate. but
It
that was
is.
good.
I know.
Okay,
All right, go.
Ready?
Speaking of fresh.
I know. Speaking of fresh, tune in next week for another fresh episode of Life as You Own It. And remember to...
Stay classy.